what I thought I would do this evening is spend a little bit of time looking at the, let's say, two business manifestations of Islamic finance. One is takafful, i.e. The form of insurance that is used within Islam. Okay, so I want to talk a little bit about the development of takafful in the context of how successful has takafful been. And in the same way, I'm then going to move on to talk a little bit about Islamic banking. And I'm particularly keen to compare both of these two forms of Islamic finance to conventional insurance, conventional banking, and to look at how they compare from a competitiveness point of view. Because at the end of the day, we live in a kind of plural world, and Islamic finance has to coexist with competitive forces, i.e. Conventional forms of insurance and banking. So we just need to compare and see how we stand with the development of these two forms of Islamic finance. Then I want to talk, I'm going to turn the tables, because then I'll talk to my comfort zone, which is technology. And I want to share some thoughts on where technology is today and what is the conventional world of banking and insurance thinking about. Right? In other words, how will they exploit technology to make themselves more competitive and to essentially be as strong as they possibly can. And then I want to talk a little bit about how can Islamic finance start to exploit the same sort of technologies, and why are we not? And indeed, my thesis will be that if we were to do so, then I think we would compete, and our development and our progress would be much faster than it is. So I'll talk a little bit about if we were to use these technologies, what would be the impact in unlocking our potential, and then finally some conclusions. So let me just very quickly start by talking a little about my company. Essentially, we work in the domain of financial services, so banking, insurance, asset and wealth management, capital markets. Those are all the domains in which we offer our technology expertise. And essentially what we do is we develop what's called intellectual property, i.e. software, which encapsulates our knowledge of those domains, and we offer that to the market. Right? So that's essentially what we do for a living. We are a global company. We have 16 delivery centers around the world, and we have about 10,000 employees. Most of our development is done in India, several centers across the Indian subcontinent, and from there we generate our client base around the world and revenues of about $275 million. So it's a well-established company, has great credentials in banking and insurance. We have about 1,500 plus customers, 50 countries, 5 continents. So a global operation, well established. 71 of the top 500 Fortune 500 companies are our clients, and our goal is to use software essentially to consistently create value for our stakeholders. So very much a software company with the goal of helping our clients create competitive advantage through the use of technology. So, as I said, we are a global operation, and somewhere or other, 24 hours a day, someone is using our software, and therefore we have to be able to deliver services 24 hours a day, round the clock. And if you notice that our presence very much is following the Islamic world. So we have a very strong presence in Southeast Asia, very strong presence in South Asia, India, Pakistan, Sri Lanka, increasingly strong presence in the Middle East, and a very fast-growing presence in Africa, which is, as we all know, an area of major development for Islamic finance. So we have quite a lot of experience in both banking and in insurance, and providing solutions to clients who are operating either in takafful or in banking. So if you look at some of the clients, they span the Middle East, they span Saudi Arabia, they span Pakistan, they span Sri Lanka, and as you can see, a lot of our clients, probably the first three columns, are all takafful clients. So this is an area that we focused on very early, and it's a really strong core competency that we have in providing solutions for takafful operators. And when you look at the right-hand side, these are clients who use our banking software. And as you can see, a lot of those are in Saudi Arabia. There's Russell Khaimah, also bank using our software. And we see a huge amount of activity, particularly in Saudi Arabia, in implementing Islamic banking. So that's the background, and very much we try to focus on bringing excellence to operators in these markets. And here's an example. One of our clients, Takafful Ikhlas, won a very prestigious award in Malaysia as the best takafful operator 2013, and that's pretty well fresh off the press, happened in October. Interesting example of a very successful takafful operator competing against conventional insurers and creating a client base of well over a million policy holders. So they know how to do it, they know how to exploit technology to make themselves competitive. Just another example, here through Infotech is receiving an award. 4 years running we have won the Technology Excellence Award at the Takafful Award Ceremony. So another recognition of our expertise in this area. So just a little bit about our background, and now I want to dwell on the topics of our talk today. I want to now spend a little bit of time talking about takafful. I want to, particularly from let's say a business context, and then we'll move towards technology afterwards. The first thing that I'd like to say is, here's the good news. Right? The good news is that year on year, global premiums for takafful have been increasing at around 20% per annum. Right? So in anyone's book, you know, a initiative that grows by 20% per year has to be deemed to be successful. Right? So having said that, we have to also remember that the premiums, which are now touching $19 billion per annum, is minuscule compared to conventional insurance. It probably isn't even 0.5% of global premiums in insurance. Right? So on the one hand, we can be justly proud that something that started in 2004 has effectively grown by 6 times in the space of 9 years. But remember that it was a small start, and even though we're growing, we have a huge, huge amount of work to do to make this a stable offering in the Islamic world. So, let's try and go in the right way. Now, that was the headline. The headline is the good news. We're growing. But now let's have a look just a little bit under the cover and look at what are the business challenges faced by takafful operators. And what I've done here is essentially to reuse a slide that I used at the equivalent lecture 2 years ago, in which we tried to list the key business risks in Takafful companies. And this is a survey which is done by Ernst & Young every year, and it essentially lists the top 10 issues. Number 1 being the most difficult, number 10 being the least difficult. And as you can see, year to year, the particular business challenges vary because obviously the market is changing, the environment is changing. But let's have a look at the survey of last year. I think the first thing that I would say is the least difficult challenge that the Takafful operators face is tapping pent-up demand, right? And that, I think, is to be expected. The market for Takafful is vast. It's so huge that we can't even imagine. And today, we're just literally touching the tip of the iceberg. So the issue isn't about demand. There is demand, and I think this is echoed from 2009, just probably prior to the financial crisis, to 2012. So the issue for Takafful operators is not about the demand in the marketplace. Having said that, look at the number 1 issue. The number 1 issue is competition. Okay, and interestingly, competition has been consistently somewhere in the top 3 as a business challenge. Now, what does that say? It says that 1, to compete against other Takafful operators is tough, and even more so, to compete against conventional insurers is very, very tough. Okay, so the fact that this is listed as the most significant business challenge is one that we have to take note of. And it's really important, I think, for Takafful operators to work out how do they make themselves more competitive and how do they secure a bigger share of the market compared to the conventional insurers. All right, so that's number 1. This year, the second most significant challenge is regulatory compliance. And that stems from 2 issues. One is, everyone's probably aware, Solvency II is lurking just around the corner for everyone. Solvency II is a very strict set of compliance requirements that every insurance company, certainly in Europe, has to face. And that requires a lot of changes taking place within an insurance operator, particularly around the data that's captured and the data that they have to provide to the regulator for transparency purposes. So this has become a significant overhead, a significant cost for insurers. And I would say that the Takafful operators, relatively young as they are, with immature systems, find this challenge quite, a significant challenge. Number 3 is shortage of expertise. And interestingly enough, this one has been up there amongst the top 3 since 2009. Again, to be expected, we are starting a new market. Takafful is effectively a new market. The expertise in it is limited. Underwriting knowledge is limited. Experience of risk management is limited. So shortage of expertise is a key issue. And as you can go down this list, probably you can read it. I won't spend too much time, we're short of time. But at the end of the day, we are beginning to see for the first time Takafful insurers talking about cost, misaligned cost relative to other conventional insurers. Right? And that's why I firmly believe that we have to grasp the technology challenge and start to address some of these issues. Okay, now let's have a look at some statistics that have also been captured, in this case by Ernst & Young. Let's look at some measures of the success of insurance companies, conventional, and takafful operators on the other hand. Now, I'm not going to argue the point as to whether these measures are relevant for takafful operators. We may agree that the purpose of a takafful operation is not the same as conventional insurance. However, takafful is competing in the marketplace against conventional, and therefore we at least have to have some KPIs to measure their success. So let's look at return on equity. And the reason why I've chosen these measures is because even in takafful, there are essentially three sets of stakeholders. The first is the investors, second is the takafful operator, and the third is the group of people who come together to actually be insured or to share risk. So there are effectively three sets of stakeholders, and I think they're all three of them represented in these statistics. So return on equity, this is what investors will be looking for. And if you can see, takafful operators, in general, if you average across the whole marketplace, are less than half as successful in terms of return on equity compared to conventional. Second, investment returns. This is, for those of you who are not familiar, where an insurance operation or a takafful operation has surplus funds, those get invested in the market, and those returns are also measured in terms of the profitability of the operation. So if you look at the success of how investments have taken place, again, takafful achieves 6% versus 11% in conventional insurance. And here we're, by the way, talking about the GCC states. This is a comparison of conventional v takafful in the GCC states. Now,
sorry, Faisal,
yeah.
Is this a particular year?
This is 2011. 2011. Okay. Now, the next measure, expense ratio. So, just to explain for those who are not in insurance, the expense ratio is essentially the ratio of all of your administration costs relative to the premium that you collect. Right? So your income is premium, and your expense is all the people and all the systems that are part of your operation, and they are your expense. So the expense ratio is an important measure of efficiency. All right? And as you can see, conventional insurance sits at 23%, takafful sits at 33%. Almost 50% less efficient than the conventional insurance. The last measure, which is called combined operating ratio. Again, let me just explain. You have premium, you have expenses, and then you have claims. All right? So if your claims plus your administration is more than your premium, it means you're making an operating loss. All right? So what combined operating ratio does is it adds together your claims and your administration, and it compares it against your premium. Interestingly enough, this ratio for takafful is 102%, which means that they are making a loss. Yeah? Their claims plus admin costs are greater than their premium. So operating loss, however, made up by the fact that when they invest their money, they get 6% return. In practice, they shouldn't bother to run takafful because they'll get more money just putting it in the open market. So I think that's another very interesting comparison, especially when you look at conventional insurers that only have an operating ratio of 77%.
What's the reason behind this? What's the reason why the expense ratio is high?
So what could it be? In this case, it would have, well, first of all, this number has this in it. So we know that they're already inefficient by way of their administration. The bit that's in here is claims. It means that their risk management isn't very strong because they're paying a lot out in claims. Right? So this comes back to the issue of risk management, expertise, systems, having data to analyze, all those things that conventional insurance companies do very well. So, just to compare, GCC is one big center for Takaful. Malaysia is another big center for Takaful. Let's do the same comparison in Malaysia. Again, return on equity, very small compared to conventional. Investment return is half. The Takaful operators in Malaysia have started to address the issue of efficiency. They're as efficient as their counterparts. And, however, if you look at the combined operating ratio, they are still, in fact, sorry, they've done better than conventional insurers. So it looks like in Malaysia, we have perhaps more mature operators who have understood how to compete against the conventional operators. All right? So that's let's say, a picture of where we stand today with Takaful. And I think the more important issue is this, let's say, basis for Takaful operators cannot be sustained. If we want Takaful to continue to grow at 20%, or if we have a desire that it should grow faster than that, it has to address those issues. Otherwise, it will not, in 10 years' time, 15 years' time, even though there's market demand for it, it will not have the sustainable profitability to continue to operate. So if you look at this from the point of view of the Takaful operator, i.e. these are the people who are inside the company that's actually managing the assets on behalf of the shareholders and dealing with insurance on behalf of the members. So they have a lot of pull and pushes going on, right, to manage the business. First of all, of course, they have to follow principles of Sharia. And that's not easy because we do not have a uniform regulatory environment in different countries. There are different practices, there are different interpretations of the practices, and that makes life very hard if you're actually sitting here in the middle trying to be compliant with Sharia. And that's a cost, a significant cost to be compliant. Secondly, they have another issue, which is not only have to be compliant with Sharia, they have to also be compliant with Solvency II, and that's another whole set of regulations, which is coming. It's a huge express train coming towards the insurance industry, and they have to comply. In fact, I believe that first quarter of 2014 is when insurance companies have to be compliant. That's a huge, huge overhead. So, as you can see, if you're a conventional insurer, the only compliance you have to have is Solvency II. For Takaful operators, we also have to comply with Sharia. Double headache. So that's a major issue. Secondly, also, the next issue is how do you safeguard the interests of everyone? Right? Because some of the regulations that are being, the edicts that are coming from the bodies where the Sharia compliancy rules are emanating are contradictory. For example, how can you use surpluses? There has been a recent edict which said that if you have an insurance surplus, then the surplus can be shared between not only the contributors, but also the Takaful operator, i.e. the people running the company. So what about the shareholders? Why shouldn't they also share in the surplus? So there are all sorts of interesting issues that have to be addressed as far as the Takaful operator is concerned. And of course, we've just talked in those previous slides about profitability. It's a challenge. How do you compete against the conventional insurance? And last but not least is consumer confidence. You were probably all excited as I was, when the first Takaful operator in the UK was formed, Principal Insurance. Anyone remember it? I'm sure you do. I think it was Salam Halal Insurance was their brand. Yes. this was 60 million pounds of investment, private investment, into the first takafful operator in the UK. It lasted 18 months. It failed to the chagrin of the Muslim community and also to the anxiety of it, because many Muslims in this country supported that operation and actually insured with it. So when it failed, it was not good for Muslims as well as the rest of the community. And it's worthy to note that this was sold last year to a run-off operator in the UK for £4.5 million. So 60 million wasted, 4.5 million was the end result. So I think we have to take this quite seriously, right? Yes, top line, we can continue to grow, but if the bottom line doesn't work, then we're all going to be extremely disappointed, and there's going to be a lot of dissatisfaction amongst the Muslims if it isn't successful. So, let's try and, so the key strategic issues then in insurance: efficiency of operation, fundamental, the quality of underwritten business, the point that we raised before, which is that unless you have the ability to analyze your risk and understand what it is that you're underwriting, then your losses, your claims will be much, much higher than you expect. And then the third strategic issue, is the issue of capital requirements, solvency, and regulation. I think these are the three most significant issues faced by takafful. Having said that, I also want to dwell on untapped potential. There is huge potential for takafful, and without going through all of these points, we see, if we can get the fundamentals right, a very, very bright future for takafful in both Islamic countries and non-Islamic, because takafful has an appeal to everyone. It's about ethics. It's about how you provide trust in a world that doesn't have trust. And funnily enough, conventional insurers, in a survey that was done recently, do not come out very well in terms of trust. So there's a big opportunity for takafful here. And also, I'm just repeating a slide that I used last time. If you look at the world, the Muslim population, in the West we have a very small population, but the GDP created by Muslims in the West is significant compared to the population, but their potential for premium is massive, right? So if you look at Western Europe and you look at Asia, USA, 50% of the potential premium for takafful could come from our markets. And I think we should be, conscious of that and try and develop takafful so that it is efficient and provides as good a service as conventional insurers. All right, Islamic banking. Good news, again, growing at 20%. 2012, we're at 1.4 trillion in assets, and the converse of that is still the Islamic assets are 1% of the world's total assets. So still a very small element, but growing at 20%. Great news for all of us that this is happening, but underlying are some, nervous signals. And I'll just run through these very quickly. These are, again, graphs of some KPIs for banks. And the first one is to note that Islamic banking produces 12% return on equity, whereas conventional banking produces 15%. Right? So in a competitive world, how can you sustain that? Return on assets, Islamic returns 1.3 versus 1.7 conventional. Cost of funds is not too bad. We tend to be able to, in Islamic banking, obtain our funds at the same sort of cost as conventional. So this, if you like, is neutral in terms of performance. The operating cost versus operating income. All right, so this is how much does it cost me for every dollar or pound of income that I get. So Islamic costs 47% of your income is essentially your cost, whereas for conventional it's 40. That is significant. To operate at 7 percentage points higher cost than your competitors, that's a tough call. Right? So we have to really address this. Provisions versus operating income. Again, Islamic is 19% and conventional is 12%. So almost on every count, we have a challenge. Right? And when you look at commentators, they recognize, i.e. experts, they recognize that Islamic banking has issues from the point of view of regulatory transformation, risk transformation, and how do they operate from a retail perspective in the market. So I'm not going to kind of dwell on this, but in the kind of jargon, this is called the 3 R's. The Islamic banking really has to deal with the 3 R's: regulatory transformation, risk transformation, and retail transformation. So I've kind of dwelt a little bit there on Takafful. The top line story looks good. Underneath, some troubles. Same in banking. Top line looks good. Underneath, there are problems. And essentially, most commentators would say that from the point of view of banking, technology is what will make the difference. Technology is required to help comply, i.e. the issues of regulation. Technology is required to help understand customers and to help understand the environment that they're operating in. And thirdly, it's all about delivery. We all know as customers of banks that unless they're delivering good service, we're not happy and we'll move banks because it's very much a commodity. So technology has to play a big part. Now I'm going to move on briskly because I can see that you're going to tell me that I've got 5 minutes left now. Okay. Now, in this section, I'm going to talk about concepts which the Western banks, or let's say the conventional banks, are debating and discussing as new technologies or new capabilities which they want to exploit to further their own businesses. So this is very much, let's say, at the bleeding edge of where the conventional banks are in their thoughts about technology. And the reason why I'm raising these is because we have to absorb all this. We have to not think of this as bleeding edge. We have to think of this as what we have to do. If we don't do it, then again, conventional banking, conventional insurance will move ahead. We, however, have to leapfrog to catch them up. So, relationships at scale. What is this all about? Essentially, what this says is to deliver service to a customer today, you have to take advantage of all of the digital information that is around that relationship. And the idea is essentially that whereas 15 years ago we used to spend all our time in IT worrying about the transactions, worrying about the second decimal place, the fifth decimal place of every transaction, that used to occupy us in technology. How do we make sure the transactions are secure? Today, that's over. That discussion is now resolved. The issue now is about how do we use technology for interactions? How do we manage the relationships with our customers through the digital information that we get? All right? And that's the challenge that conventional insurers and conventional banks are grappling with. I think we have to start thinking about that. It is all around the fact that today there is so much digital information available about you as the consumer of a bank's or insurance company service, and how does that institution use that data to make sure that its relationship with you is as if though you were the only customer. Right? So it's about mass personalization. Right? To make it sticky, you need to be their client for a long time and not move. So that's a key issue, is around what we used to call CRM. It's an outdated term. It's now really all about relationships at scale. We have millions of relationships, but each one thinks it's an individual one. That's the challenge that is being thought about, because technology is able to address that. Secondly, the issue of collaboration. Now, this is really all about the fact that working institutions have typically departmentalized everything. Right? In order to make organizations work, we have had departments, and departments have been silos. And guess what? Technology, when it first came, mimicked exactly that style. So you had silos of technology, and what those silos did was effectively to accentuate the silos. So what do you have in banks today? You have scenarios where one department simply doesn't know the information that's in another department. How many of you have been on the end of a telephone trying to speak to a bank and being pushed from department to department? The reason is because the information isn't there for all of those workers to be able to address your issue. So in today's world, this thing that we call seamless collaboration is, how do you use technology to enable all of the people in your value chain to have the information to provide service? And this really does address the kind of fundamental issue of efficiency. Because where you have to keep going from department to department to get something done, that's where cost escalates. So we've seen social technology, things like Facebook. These are relatively new technologies, and they really have opened up, let's say, the way in which you can open up information across silos. Right? So the key issue here is embedding of social technology into enterprise technology. Third area that people are looking at, design for analytics, and there's a lovely term. It basically says that today we are generating huge quantities of data. And just some lovely statistics here about what happens as a result of the internet every 60 seconds. So just to explain, dwelling on it for a second, another term for this is big data. Some of you may have heard the kind of IT fraternity use this term, big data. Let me explain a little bit here. Interesting fact, in the last 2 years, 90% of the data in the world was only created in the last 2 years. So before that, we had conventional systems. All they did was generate transaction data, but suddenly the world is open up to data of all sorts in real time being generated. Right? And we're all part of that. We use Facebook, we use Skype, all these sort of technologies is adding to the amount of data in the world. Now, in the interest of time, I'm not going to go around all of this, other than to say that this figure is quite interesting, that on a daily basis we're generating 2.5 quintillion bytes of data. Oh, what the hell is that? A byte is a letter, right? Now, the comparison is that Wikipedia has 2.5 billion words. That's the size of the English Wikipedia. So this figure is essentially 1 billion Wikipedias every day being generated. Right? That's the quantum leap in terms of data that is now sitting in servers and in databases all around the world. And the challenge, and I'm not even going to dwell on this, other than to say that 5 years ago I wouldn't have known what an exabyte is, but because technology is moving on, we have to invent new levels of measurement of data. So we're now at a yottabyte. Maybe you want to take that one away as a freebie from me. What is a yottabyte? So the real issue about design for analytics is that you have this sea of data, a massive quantity of data we've never ever imagined before. And in there lie nuggets of gold. And from a corporate point of view, we have to find ways of making sure that we have technologies that can navigate that data and help it to create a better understanding of us as an organization and of our customers. If we can do that, then we really start to leapfrog where conventional insurers and banks are today. Very quickly, this talks to the fact that everything today is real time. Yet, enterprise systems were designed to be batch. And so there's a real need for enterprise systems, banking systems, and insurance systems to move into a world where data is generated in real time, and you need to be able to analyze that data in real time and take decisions in real time. So this, again, is a topic that is exercising let's say, the cutting edge of finance industry today. Now, I'm just going to very briefly touch on a couple more topics. Some of you may understand virtualization. Processing virtualization is something that's happened already. It means once upon a time we used to run one program and one operating system on one processor. What virtualization has done is it's allowed us to run as many programs as we want on as many processors, and it's transparent, nobody knows. So this means that processing is now a commodity. And we've done the same with storage, i.e. where we actually hold data. We have virtualized it so that through storage networks, we don't care where the data sits. We can always find it, and we can manage huge amounts of it. The thing that's happening now is the same with networks. In other words, we're going to be able to manage networks through software, and this will bring another level of flexibility and agility in markets. And this is something, again, that the conventional banking and insurance world is looking at. The cloud. Everybody's heard of the cloud. Ultimately, what does the cloud mean? It means the movement from fixed cost, because in the old days you had to buy £2 million worth of hardware, £1 million worth of software, a lot of network before you could even start business. Today, in a cloud environment, you're basically buying a bit of an infrastructure that already exists. So you're moving from fixed cost to variable cost. And that is a fundamental shift. When we looked at things like return on assets, return on equity, this is a shift that we have to absorb in the world of Islamic finance. And just another question about the cloud. Today, you're a traditional IT player. You have everything under your own wing. Today, you can have a private cloud, you can have a managed cloud, you can have stuff on a public cloud. So again, this is offering all sorts of new flexibility and new choices to people who are savvy enough to understand what they are doing. Many banks today will not consider cloud. They say it's not secure. Well, they haven't understood what cloud means because there are things...
Many or most?
Still many. Many banks are reluctant. Most banks are still reluctant, even though things called private clouds are very secure now. So, as I said, this is at the bleeding edge of what conventional banking and insurance is talking about, and this is stuff that we therefore need to absorb and use to leapfrog. So, I'm beginning to wrap up now. What I've done here is to say there's 6 technologies that I refer to and gallop through very fast. If you list those on the one side and you look at the key issues, the strategic issues in Takafful, which were efficiency in operation, quality of underwritten business, solvency and capital requirements, you can almost do a mapping of which technology has high impact, which technology has medium impact, which technology has low impact. And I think it's really important that for us, we do that analysis. Okay? It's not a 10-minute exercise. This is a long piece of work that we need to do as supporters of Islamic finance to understand how do we gain expertise in order to create high impact and leapfrog into a new era. So in a similar way, we talked about understanding the business, technology to deliver, and technology to comply. And we need to understand all of these technologies, and indeed there are others. I mean, if we had 3 hours, I'd go through them, but these are probably the most significant. And we need to understand which ones have high impact and really start to invest in understanding them and in exploiting them. So, my conclusions. The first is that we need to really address the underlying performance of Islamic financial services. I didn't make those figures up. They are published. They are available to everyone. We tend to ignore them because we like the headline news. We need to understand what's going on underneath. We need to understand that technology can be a weapon. I will tell you personally that pretty nearly every Islamic insurance, takafful and banking operation that I've come across has viewed technology as a necessary evil. Now, we have to have it because they have it. We have to have it because we can't run our business without it. That's a defensive reason for having technology. My contention is that we have to turn that around. We have to think of technology as a weapon, and we need that to enter into the Islamic finance debate. And ultimately, of course, the people that will drive this will be the boards and the CEOs of Islamic banks and of the takafful operators. And I think the key issue is, do they even understand? Do they understand what this debate is about? So we have a huge amount of learning, education, knowledge transfer that needs to take place. So we need to take sound external advice. And here I'm just going to point out that we talked a little bit about principal insurance. And I sat on the periphery watching this. They chose Capita as their outsourced provider of IT services. Capita is the most expensive outsourced operator in the UK, right? And for me, that said it all. So, and the reason that decision was taken because nobody on the board of principal understood anything about IT. So we really have to get across to the people who are in the leadership position, what is the real benefit of technology and how should we be using it and what should it cost? And my last point is, in the UK, we have many young, outstanding, and bright technology experts. And we have to harness their knowledge, and we have to bring it into our debates. We have intellectual debates, we have academic debates about takafful and about Islamic banking. We need to have technology debates as well. Okay, just to close off, my last slide. Everybody will be familiar with recent initiatives in London by the Prime Minister to try and create London as a centre for Islamic finance. And everyone knows that Kuala Lumpur is vying for supremacy, Dubai is vying for supremacy, and so now London is also. We don't have a very good track record when it comes to the retail side of insurance and banking. We've seen the story of Principal. In fact, if you look at the 6 Islamic banks in the UK, none of them is profitable. Right? So that's not a very strong story to tell. But on the wholesale side, with things like the government creating the sukuk, there's a huge amount of activity, and we need essentially to use our expertise to make sure that London is preeminent. And that's being very parochial. I have a very personal interest for, and I guess you guys do as well, for London being a centre for Islamic finance. And my assertion is, yes, we have lots of expertise, legal expertise, we have accounting expertise. We do not currently encapsulate technology expertise to offer as a centre of excellence or centre of competence in London, and we need to start doing that. So I think with that, I'd like to throw this open to questions and see what you think.